The following is a paid program, and the views expressed do not necessarily reflect those of WJZ-FM, Odyssey, its sponsors, or affiliates.
The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Good morning. I'm Brian Akers from Akers Financial Group. I'm a certified financial planner practitioner and the host of Winning in Retirement. Today, I have a special guest. This special guest is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management out of Chicago. Mark, good morning.
Happy to be here, Brian. Thanks for having me.
Oh, yeah, it's awesome to have you on our show again. Mark DiOrio is a portfolio manager and the chief investment officer, actually, at Brookstone Capital Management. And we use them as our third-party money management group. And they have many portfolios that we use and we apply to our clients' investing situations. So, Mark, tell us a little bit about yourself.
Oh, sure. So I've been in the industry for more than 20 years now, and including about 15 years of multi-asset class portfolio management, which really means I look at across the board stocks, bonds, alternative assets. And prior to joining Brookstone Capital Management, I was responsible for launching and managing an investment management subsidiary of a publicly traded regional bank holding company. And then I met the good folks at Brookstone Capital Management and joined as Chief Investment Officer. And in that role, what I do is I lead the firm's investment committee, and that drives the firm's overall investment policy and portfolio construction methodology. And part of that is overseeing the portfolio strategy group that provides recommendations on strategic and tactical portfolio design. And then from there, I also present and produce content for advisors and investors, both in a weekly format and written and verbal and so forth. So I'm really excited to be here and be part of Brookstone. I joined in 2015. It's been a great run and really excited, and I've had a great relationship with you and your firm, Brian.
Yeah, it's been really good the last few years. I know you're known for your jokes, so we're not going to really make you say any of your jokes during the show today, but we're going to enjoy our talk. All right, so Mark, you got 20 years experience, and then that was coming out of college. Which college did you go to?
Sure. My undergraduate was at Eastern Illinois University, and then I went to graduate school and received my MBA from Benedictine University.
And then you're also a CFA?
Correct. So after that, I joined as an investment analyst. That's usually where you start on the investment side. And then at that time, I started to pursue my CFA, which is a Chartered Financial Analyst designation. It takes about 3 years to get that designation. It's a series of tests. It's not really as popular in terms in the mass media in terms of the designation, but it's very well respected in the industry for managing money and kind of the union card, if you will, for managing large sums of money. So I did that, and then during my career I've kind of held various roles, but each with increasing responsibility. So when you said portfolio manager at the beginning, I was a portfolio manager for a dozen years directly before I assumed Chief Investment Officer responsibility. So I've been in multiple investment committees and policy decision-making areas.
Sure. And at Brookstone, what's the assets under management at Brookstone Capital right now?
So it's been very exciting. When I joined, we were about at $1.5 billion. Today, we're over $7 billion.
Yeah, that's a B, right? The letter B.
It is a B, billion. So we've been able to manage a pretty successful growth trajectory while not really reducing any of the value proposition that we've provided. So we've really staffed up to provide a lot of investment research and investment capabilities, both on the back office, the operations side. We're a lot bigger than we were when I joined, and so I think we're all very excited what lays in front of us, because we think we have a very, very interesting and challenging markets ahead of us, but that also provides opportunities as well.
Exactly right. And that's what our show is going to be about today. The topic today is this: are you properly diversified in today's market? Today's market requires your full attention. Today, the show with Mark DiOrio, we're going to talk about the aspects of stock and bond market and how to properly diversify your investments and what's going on throughout the action of today's markets, the ups and the downs. All right, Mark, let's just do a real simple question. Diversification. What's your opinion of diversification, and does it really work?
So diversification is the principle of dividing your assets into multiple different asset classes. So an asset class is a set of similar securities. So stocks are an asset class, bonds are an asset class, and then from there you have a lot of sub-asset classes, so large cap, mid cap, small cap. For stocks, for example, those would be different asset classes, or growth versus value, different asset classes or sub-asset classes among that. But the point is, you own a combination of those asset classes consistent with your risk profile. So if you're a little more aggressive, you'd own more stocks. If you're a little more conservative, you'd own more bonds than stocks, just brushing it with broad strokes.
Yeah, diversification has been the way I love to work on portfolios for my clients. And that diversification is truly all part of the asset allocation, the allocation between different types of asset classes. And so during today's show, we're going to talk about different asset classes, different styles, different investments, different thoughts. One of the things I wanted to do as we began is, can you try to explain the stock market over the last 3 months, like sort of like in the rearview mirror, what happened since January 1st of this year?
Sure. So since January 1st, we've had a great run to start the year, and it's really a continuation of where the market was as we ended last year, as it was rebounding from the pandemic lows in March of last year. And then we had a lot of fiscal spending, monetary stimulus come in the market to really help bring that back into line. In addition, we have the prospects of potential recovery on the COVID situation as we run through that. And remember, that was an exogenous event onto the economy. In other words, it wasn't an economy that was necessarily weakening in the traditional sense for pretending a recession. It was an exogenous health crisis that came in and really shocked the market. And when you close businesses and close borders, well, the only place to get cash for liquidity is the markets, where you kept the markets open. So you did have a lot of selling in March, but then there was a lot of fiscal efforts and really policy that came in to help stabilize those markets. And that's what the monetary policy is supposed to do. And then starting this year, one of the interesting dynamics has been that value stocks, traditional value stocks, or companies that are more levered to the economy and the economy growing, has started to outperform some of the technology darlings that did really well last year. So it's been a broadening out of the rally and really healthy part of the market, I think.
Right. So that first quarter has been very, very good. What do you think about this next quarter and maybe throughout the rest of this year? Is this a bull market that's just getting started? Are we on a rocket ship to Dow 50,000, to NASDAQ 10,000, or S&P 25,000 over the next few years? What's going on? I guess that's just a huge question of different aspects there. But where do you think the market's headed?
Sure. So I would look at it from two time frames. One is what are called our cyclical view, which is shorter term, let's say 3 months to 1 year. And then our secular view, which is 1 year and beyond, meaning what kind of environment are we in overall? So in the cyclical view, we'd say have reasonable expectations of what the market can do, given that it's just had a nice run up here, and that a natural kind of pause can happen at any time, and a natural correction, but that's not the end of the world. Corrections can happen, and they're not devastating. But you could get some headlines come in, and the market just moves sideways to consolidate some of the gains. So that's in the short run. It's not a bearish view at all. It's just, hey, you could have that, and then the market then resume on its natural uptrend later in the year. And then looking out longer, and you talk about Dow 50,000, that's not that far away if you just break down the numbers. So if we were around Dow 34,000 today, you're talking about great gains, but could it get there in a few years? It certainly could, given the fact that we think we're in a secular bull market underpinned by massive fiscal stimulus, monetary stimulus, and ultra low interest rates. And so stocks have really benefited from that. And then when you take on top of that an expanding economy that's really been outpacing, and the U.S. economy in particular, that has been outpacing the rest of the world.
Wow. Yeah, that's a lot of information there, but that sounds very positive for the market. I guess there are some headwinds that cause the market to have some caution, and we're going to definitely be covering that during the show. I guess one of the headwinds just might be future tax changes on capital gains and things like that.
Correct. So there's always policy risk, and I think we're in that arena where we could get those challenges where the market could get bumpy. In other words, the market might get a little bit ahead of itself, and that's maybe, as we're talking today, it might have just run up to a point where you say, oh, it got a little bit ahead of itself, and maybe it hasn't discounted some of the risk factors, such as, well, what happens if international relations become a little bit more strained, such as with China? What happens if they change tax policy? That's obviously going to spook the market a little bit. I wouldn't overdo it. It's not like a 2008 environment, but these are challenges that the market will have to deal with and figure out who the winners and kind of who are the losers are.
Right. So investing is really based on people's unique situation. At Akers Financial Group, we look at their unique financial fingerprint. That's where we begin. And then we build portfolios that are designed to meet the needs of that client. Now, throughout the show today, we're going to be talking to Mark about, are you properly diversified in today's market? Mark is the Chief Investment Officer of Brookstone Capital Management, and they bring to us third-party money managers that we use for our clients' portfolio allocations. So we design on a unique basis for each and every client. And that's what really, truly allows us to provide what the client needs and what can be in their best interest to reach all of their goals into and throughout their retirement years. The neatest thing is this, is that the best part of retirement is when you get your time back. You decide how to use it. Before your retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away when you're retired. Your time is now consumed by things you want to do. And when you have Akers Financial Group and our third-party money managers handling your investment money and building a portfolio that is built for you, that helps you have this time back that you can do many other things. To begin winning in retirement, give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and Susan will call you back on Monday to schedule a virtual meeting, which can be a phone or virtual Zoom, or in-person meeting with one of our team of advisors. Start planning for your retirement now. Give us a call at 833-946-7384 or visit AkersFinancialGroup.com. Value stocks and growth stocks are not the same. We will explain when we come back.
You are unique. Just as no two fingerprints are alike, each individual's financial situation is uniquely their own. That's why the Akers Financial Group's team of advisors begins each relationship with a proven process that identifies your financial fingerprint. We'll guide you through a series of steps designed to provide a complete and accurate snapshot of where you are right now. Everything we learn about your financial fingerprint will become part of a detailed financial plan created especially for you. We'll never give you a cookie-cutter proposal or suggest a one-size-fits-all portfolio. The financial plan takes you from where you are now to where you need to be. Begin by discovering your financial fingerprint right now by going to getmyfinancialfingerprint.com. That's getmyfinancialfingerprint.com.
Member FINRA SIPC.
Imagine you're retired. You wake up in the morning and you don't even know what day it is. Every day seems like a Saturday. You can sleep in, cook a nice full breakfast without thinking about morning traffic or work deadlines. The Saturday calmness you used to crave is now your everyday feeling. You're not worried about your retirement income or how your investments are doing. Your biggest decision that day is where you're going to drink that first cup of coffee. Is that the kind of retirement you want? If it is, then sit down and talk with the team at Akers Financial Group. They want to help you get there. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. I'm a certified financial planner practitioner and I'm president of Akers Financial Group. Here today with me is Mark DiOrio, the Chief Investment Officer at Brookstone Capital Management. He's been in the financial industry, working and developing investment portfolios and running investment committees. So we invited him to our show to talk about this topic. And the topic is, are you properly diversified in today's market? This show is for you. You need to listen to this to make sure you're properly diversified. Mark, are you ready here for the second quarter?
Oh, let's do it, Brian.
All right, that sounds awesome. All right, my question leading into the second quarter is this. Value stocks and growth stocks are not the same. What's your opinion of that?
They are definitely not the same. They have different drivers to performance. So growth stocks are those stocks that are growing faster than the economy and typically trade at a higher valuation level because you're expecting faster growth. And the largest sector in growth, what's the sub-asset class category of growth equities, is technology. So all those large technology companies that come to mind. And then value investing are companies that are usually trading a little bit cheaper in the marketplace and are more levered to the economy, in other words, the performance of the actual economy. And so the largest sector in value investing are financials, for example, traditional banks and those groups. And industrials fall in there, so those are traditional industrial companies. So those businesses do well when the economy is doing well. Growth stocks, or led by technology stocks, actually don't need a growing economy to do well. So when you have, and so the names kind of throw investors off sometimes because you'd think a growth stock would do well during a growing economy, but it's just the reverse, meaning they're growing regardless of the economy. Where value stocks will do well if you have an economy that's growing fast. And right now, we do have an economy that's really growing pretty fast in this recovery path. And so value has taken the lead from growth stocks in this front part of the year.
Right. So pretty much after the vaccine was first announced back in November, value stocks were down for the year 2020 until that point. When I look at value stocks, I really think it's sort of the broader market. Value stocks typically companies that have been around a lot longer?
Definitely. So all those traditional blue chips, in fact, the Dow Jones Industrial Average was based on industrials, traditional companies. And over the years, they've tried to adjust that to incorporate some more technology names. But the reason why the NASDAQ gets quoted sometimes, where if you go years ago when when I first got into the business, the NASDAQ was kind of an afterthought. You know, it had some of those companies that, maybe they'll become companies. And they were a lot of technology stocks. And sure enough, today it's quoted along with the S&P 500, the Dow Jones, and the NASDAQ. And so it's a tech-heavy stock market or stock gauge.
Yeah, when I think about the markets and I think about value versus growth, my brain has like a detour, and it sort of goes into something that's not really value or growth, but the concept of cryptocurrency. Can you just give your quick thoughts on that when it comes to cryptocurrency?
Sure. So cryptocurrency is an emerging asset class, and this is really important. We don't think it's a currency in the traditional sense, so it's not going to disrupt the U.S. dollar, for example, and you'll just be using cryptocurrencies or something like that. And in fact, it's not really designed for transactions for the most part, and we'll see developments down the line. But it's really an emerging asset class that has really had a lack of clarity for what I'd call regular investors. So there's just it's very newsworthy, so it gets on the news, and prices swing around a lot, and so the volatility creates news headlines, but it's still a very small market in terms of the investors' access. So a couple of points on that is that for regular investors, the major custodians like TD Ameritrade, Schwab, they do not custody crypto assets. So, and those two companies alone have over $6 trillion, maybe it's $7 trillion of investor assets. So you don't really have a good on-ramp there or an allocation there. And then two, the SEC, the Securities and Exchange Commission, has not approved an ETF, an exchange-traded fund, which would be the normal investment vehicle in a traditional account that you could invest in. So it's a little bit different animal. We are watching the developments in this space, and we are taking it serious. But once it becomes, once there's more formal regulations around it, and there's some guidance from the SEC, I think that's when we'd start to look at those in terms of embracing them in portfolios. But at this point, it might be a little bit premature for most investors to include as part of their portfolio.
All right, so I got to ask some counter questions. One is this just a shiny object, like the shiny new topic for the day where people get excited about it? And then more and more people have the FOMO, the fear of missing out, of missing out on things like the cryptocurrencies. Well, I guess what you're trying to say is that this is a building new asset class. Do you mind explaining that a little bit more? Or what's your opinion of, is this the new shiny new object?
Sure. So there are different types of cryptocurrencies, and their policies are different. So the largest two are Bitcoin and Ethereum. And so Bitcoin's nearly $1 trillion market cap. And so a good way to think about that and what's been going around is digital gold. And that's the idea behind it, because it's digital, meaning there's no physical form of this. One of the benefits is it's decentralized, which means there's only going to be 21 million, and no government or any other person can change that issuance. And so that's what it means by saying it's decentralized. No one controls it. It's a consensus mechanism. And it's also scarce, where it has that cap of 21 million. And so that's kind of the value prop with Bitcoin. But if you go down to Ethereum, you have a little bit different value proposition. And then if you go down to even something that was very popular, Dogecoin, which started as kind of a joke or a meme, and an internet meme, has created a lot of value, or investors getting that FOMO. But most would say that's just speculation and really not an investment, long-term investment.
Right. So we have that aspect going on, and many people are putting, especially new investors, are trying to put all of their money into that idea. And what we want to try to get across is that value and growth stocks is really where your core portfolio should be. And the shiny new object should be something where it's in an account where it's okay if you lost all your money. It shouldn't be part of that long-term retirement plan, that long-term growth plan. So when we're talking about value stocks and growth stocks, do dividends still matter when it comes to company stocks?
Well, Brian, I think dividends absolutely still matter. In fact, if you go back for the long-run data of the stock market, dividends account for 50% of the total return of the stock market. So anytime you see those returns quoted and the growth of the market, you're looking at if dividends are included in that overall return. But if you were to look at the media or any news report or any, the newspaper even, it always quotes the price of the market or the index or the stock. It very rarely talks about the income that's being generated and paid out to shareholders in the form of dividends. So a dividend is a percent of the profits that the company pays out to you. And really, if you get back to the fundamental reason for investing, that's a real key component and a real benefit to be a shareholder, because if earnings are growing faster than the rate of inflation, and you're participating in getting a percent of those profits kicked out to you as a shareholder, and they keep growing year in, year out, that's a great value over time. And in fact, we've seen a lot of success stories with dividends. So I think dividends in today's world, when you consider how low interest rates are and how low interest rates are for bond funds, are really an underappreciated asset.
Yeah, absolutely. The dividends are part of value stocks because these companies are producing at a very nice cash flow. And instead of reinvesting into the company or buying other companies out, they take portion of that cash flow earnings and they send it right back to investors through a dividend. That dividend is usually can be a check sent directly to your bank account or can be reinvested into the stock that you own. So value stocks are the more broader market. Do you feel that value stocks might get ahead of themselves because a lot of companies are not fully back to work?
Well, I think this is where the excitement for early investors kind of that have transitioned into some of the value stocks are excited about, saying that, oh, we have a little bit of ways to go. In other words, the economy's not just going to stop growing as we all come back online and the economy gets back to full growth mode and full on mode. So with interest rates still low, remember we have a lot of fiscal spending still to go. We've had $5.2 trillion in fiscal spending since the pandemic started. So this is pretty robust spending that's going to find its way into the real economy, and that's really to the benefit of those value stocks. And so I think the economic growth is going to continue for some time.
But there is some headwinds against that, correct?
Well, definitely. So it's not an easy call or an easy play. You still have to build a portfolio in this environment. In other words, there's some areas that have been very volatile year to date and are down. So some of those really hot areas from last year are actually down this year. And those are companies that came out with a lot of prospects, a lot of growth prospects, and they're down this year. And so it's not as easy to just say it's all working. You really have to think about your portfolio. And the other component is, what do you do with bonds, given the low interest rate environment?
Yeah, absolutely. And that's going to be one of our big topics of the second half of our show. Now, at Akers Financial Group, we're local, we're independent. We don't report to a big company on Wall Street. We report to you. We have offices in Lutherville and Forest Hill, but we work with clients all around the country. This is all about your retirement, not about us. To begin winning in retirement, give us a call at Akers Financial Group to schedule your free meeting. Call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. Go ahead and call right now. When you call, leave a voice message, and Susan will call you back on Monday to schedule a virtual meeting or an in-person meeting with one of our team of advisors. Start planning for your retirement now. Give us a call at 833-946-7384 or visit AkersFinancialGroup.com. Should you hop on the bond market seesaw? We will discuss this in the second half of Winning in Retirement.
Long before 18-year-old Brooks Robinson was signed to play third base, and years before Natty Boh began brewing at the corner of Conkling and O'Donnell Streets, Baltimore families relied on the Evans family and the Evans Funeral Chapel and Cremation Services to help them during some of their most important family moments. Hi, I'm Charlie Evans, and for 4 generations, my family and I have been there for families, providing care and compassion in their time of need. Evans Funeral Chapel and Cremation Services provides the best facility, staff, and personalized service for your family. We have 3 convenient locations to serve the community: Parkville, Forest Hill, and Hereford. For more information, visit us online at evansfuneralchapel.com or call 410-665-9444. Evans Funeral Chapel and Cremation Services, serving Baltimore families since 1865. I invite your confidence.
Are there times in some games you wish you could just turn on the TV at the 2-minute warning? Because that's the most important part of the game, right? When it comes to your retirement, don't wait until the 2-minute warning. Sometimes, so much happens right before you retire. Don't wait until your retirement 2-minute warning. Whether you're in your 50s or 60s, near or already in retirement, there's still time to put a plan in place to make changes. Don't wait until the last 2 minutes and say, okay, what do I do now? Can you win the retirement game like that? Come in and talk with the team at Akers Financial Group. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back. I'm Brian Akers, certified financial planner practitioner from Akers Financial Group. Here with me today is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. Brookstone Capital Management is one of our third-party money managers that handle the investments for our existing client base and our portfolio designs. Mark's been in the industry for over 20 years, and he's here on the show. Hey, Mark, you're coming out of the locker room. It's the second half of Winning in Retirement. How you doing?
I'm great. My favorite part as a kid of halftime was getting the orange slices.
So you're an orange slice kid? I heard that you're a coach still. You're a coach now,
I am.
Too.
Yep.
Do kids do orange slices nowadays?
No, we don't do snacks. Don't do orange slices. Don't touch each other. No high fives.
High elbows now?
Yes, definitely.
Yeah, that's cool. All right, so this question to start out the second half is this. Should you hop on the bond market seesaw?
Well, this is a real challenging question for our era. So talking about properly diversified and diversified for today's market, it's important to take a step back and really take a look and say, we're in a post-pandemic era where we've had a lot of fiscal spending to combat the crisis. And so this is a different environment than we've had. And even if you go back to 2008's issues were an over-leveraged household sector. Today, because of the government spending, we have a major government debt challenge, and that has different investment implications. And the most straightforward difference for investors is that the interest rates in 2007 heading into 2008, the short-term interest rates were near 5%. And today, they're near 0%. So as the rates dropped from 5% to near 0%, that actually helped push bond prices and returns higher during the last 12 years. In other words, it didn't affect your overall return, and the bonds were actually doing quite well as part of your overall portfolio. But today, going forward, it's a lot different because the forward return is linked to the starting interest rate. So looking ahead, that bond component of your portfolio isn't and may not keep up with even the rate of inflation. So those low interest rates have a definite implication, and it really is requiring you to have a more thoughtful approach to your bond allocation, where I know stocks get all the headlines, but bonds are a really important component to the portfolio, especially as you get into retirement and really are looking for that income. And that also adds, just to pivot from the last conversation, the last segment where we talked about dividends, saying, dividends play a real big role here, especially supplementing that income that's now not part of it, not being generated from your bond component of the portfolio.
Yeah, when I think of bonds and I think of this word seesaw, the idea there is these bond mutual funds especially, when interest rates are going up, the bond values actually go the other way. So when interest rates start to move up, your bond values will go down, almost like the opposite end of a seesaw. So if you jump into like a bond fund, you will get the interest, but you might see the actual capital go down in value because of interest rates going up. When you think about interest rates in this ultra-low environment, do you think it's going to stay low in the short run, or do you think it's going to start to ease up or go or head up? What's your opinion on interest rates?
So in the first quarter of 2021, we saw the biggest decline in value of the long-term Treasury, the U.S. Treasury, that's what the U.S. issues to fund the fiscal spending, that we've seen in 40 years. So the most conservative investors actually saw prices decline, which throws investors off. You think you're conservative, But you're in bonds, and if interest rates rise, as you're alluding to, bond prices decline. And with these low interest rates, the challenge today is, well, geez, is the interest enough to offset any of the principal decline that you see? So in the moment, the seesaw might be a pretty good definition, because interest rates are moving back and forth, and we're going to see that. But the general trend might be for higher interest rates, but at a slow kind of seesaw pattern. So it won't give you, maybe they're not going to abruptly go higher, and that's not the history of the bond market. But it does move you around quite a bit. And again, the challenge is you're starting at a pretty low level, so it might not compensate you for that risk you're assuming in the bond portfolio. So you really have to think it through of how you position the bonds, and maybe think of some creative ways to generate income out of there, and also offset your equity risk. That's part of why bonds are in a diversified portfolio.
Right, and I think of these target date funds that have a bond portion, and their concept is each year as you get closer to retirement, you put more and more into bonds. And I'm thinking that they're buying at an all-time high on the bond side, and that's going to be causing a portfolio drag for these target date funds. So in the portfolios that we're designing, we're trying to do our best to have our lower risk money have zero principal risk, and that's where we use laddered fixed annuities as a concept to handle the bond replacement. But we still have bonds and portfolio design. What's your thought on target date funds when it comes to designing, and as like the only choice at people's 401ks nowadays?
And this has been a very popular choice in 401ks because it seems logical. You say, I'm going to retire in 2020, so I'll pick a 2020 fund. It'll make the allocation adjustments for me. However, if you think about what happened in 2020, stocks went down and bond prices went up, but interest rates were at their lowest that they've ever been, or at least in the modern history in the last 50 years. And so during 2020, the fund is expecting you to retire, so it's getting more conservative. So it's selling stocks at low levels and buying bonds at high prices or low interest rates and locking in that low interest rate. In other words, doing the exact opposite of what we were suggesting at the time, which was rebalance your portfolio back. You're going to increase, you're going to buy some stocks, sell some bonds. And so that's really a flaw in the target date strategy to be mindful of. And a lot of investors don't realize this, that they just moved into bonds. It wasn't making a value decision. It was making a decision based on what's called a glide path. And all these funds use this. So, and they're from the big major houses, that run the 401ks, but they all do this where they're just systematically based on your age, not based on the market conditions, reducing your stocks and buying bonds. And we don't think that's probably the best way to really approach this environment.
Right. When we've been thinking about opportunities nowadays, I know that there's a category of themed investment or thematic investments. I thought that'd be a good topic for you to give us a little summary of that.
Sure. So thematic investing is really about identifying a different segment that crosses asset classes, but really looks at what's happening in the market. So if you think about autonomous driving, if you think about genomics, if you think about robotics, the next generation web, all sorts of disruptive innovation, and it goes on from there, even ESG, which is called environmental social governance investing. What this allows you to do is actually allocate to areas that might have robust growth going forward and is a little bit different and provides a different dimension to your portfolio. And we've been looking at and studying the space and have liked it a lot, and to include it to portfolios because it gives portfolios exposures that you just don't get through really some of the traditional core portfolio construction methodologies. So this is an area we're going to continue to look at, even if it declines, even if it's volatile. That's just part of what we see over the next 10 years, meaning there's a lot of new developments and innovations that are going to play out and really was sped forward through the pandemic. For example, the need for technology and the adoption of technology and the work from home. There's just a whole bunch of really exciting areas.
Right, and so that's in a portfolio that we uniquely designed for people, and that we should put certain portions into these concepts. We have managed portfolios, and then you can add side pockets of investments on top of the portfolios that we design. Have you seen that often in the portfolios you've been running throughout your company?
Yes, definitely. And so from an overall portfolio construction perspective, and given kind of the outlook for bonds and core portfolios and their impact, what we suggest is a core plus satellite allocation framework. So you have your core risk-based portfolio, and then you have these satellite allocations around that core, and those satellite allocations are used to augment the core risk-based portfolio with an enhanced opportunity set, and that can be in the thematic space. You're looking for more growth, and a lot of those companies or those stocks may not be in the core portfolio because they're not in some of the traditional indexes. So some of these really innovative companies really aren't in the indexes, they're just underrepresented, and that's the opportunity where you're in before a lot of big money comes in.
Right. Well, this sounds interesting. I like the topic that you said, core plus satellite. So can you explain that just a little bit more?
Sure. So we think you identify, and you do it with your financial fingerprint, Brian, which is you identify your risk profile. The question isn't what's the best investment. The question is what's the most appropriate portfolio for you, because you won't know what the best investment is until hindsight, but you can design an appropriate portfolio. And so you figure out what's your risk profile or your financial fingerprint, and then you determine, okay, we have a core portfolio that'll be fully diversified, consistent with that risk profile. But we don't stop there. Around that core portfolio, we have a lot of satellite ideas, such as maybe it's in thematic growth, disruptive innovation stocks, maybe it's in areas that could augment income, for example, on the portfolio. And you can identify this, again, with your financial fingerprint to say, oh, you have some preferences that maybe you like genomics, so you have an interest in the next generation of healthcare. We can allocate a reasonable amount there, and it's not an all or none bet. You're putting it as a percent and an appropriate percent of the portfolio. So this really gives you kind of that customized portfolio solution.
Absolutely. I think that's a great way to look at investing in today's markets, and trying to make sure that your portfolio is built for you and your exact situation. Now, many times what people are doing is they're sort of sitting at home, and over this last year, you might be very defensive. You're not sure what to actually do when it comes to your investments. What we need to be doing is looking at opportunities. Sometimes what you need to do is sit up and be in a creating mode to where you can see the opportunities in front of you and take advantage of that. One of the opportunities that we would like to recommend is that it's a choice about a financial advisor you work with. Won't you get a good second opinion by giving us a call for a free meeting with one of our team of advisors at Akers Financial Group? You can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, you leave us a voice message, and Susan will call back on Monday, schedule a phone meeting, virtual Zoom, or an in-person meeting with one of our team of advisors. Start planning for your retirement now. That's 833-946-7384, or visit AkersFinancialGroup.com. Your investment statements are the ingredients that create your retirement cake. We will bake this with you in the fourth quarter.
The choice of your child's school is vitally important. Wouldn't you go a few more miles for something really special? I'm Brian Wilson, principal of Harford Christian School. Harford Christian is an independent school in northern Harford County, serving students in preschool through 12th grade. Our Uncommon Core makes all the difference. For nearly 50 years, we've partnered with parents in the important responsibility of training children in God's truth. Our biblical worldview stands in stark contrast against today's culture. At HCS, political correctness is never prioritized above God's unchanging truth. We hold the bar high as we prepare students to serve God's kingdom, not just the workplace of man. Affordable tuition and transportation options put the choice of Christian education within your reach.
Come visit the longest established Christian school in Harford County. You can become acquainted with us through a private tour or on the web at harfordchristian.org.
Akers Financial Group was founded on the principles of integrity, trust, and service. We believe each and every client is unique and deserves advice and implementations that apply directly towards their personal financial fingerprint. This financial fingerprint tells us the objective risk tolerance and purpose of the investment and insurance tools that we use to assist our clients in reaching their goals. By discovering the purpose of each financial decision, we can help you accomplish your goals. Intelligent financial design starts with a detailed balance sheet and cash flow to know where to start. This leads to a financial decision that will allow you to reach your goals with your risk tolerance in mind. Our relationships begin with an initial consultation and grows with each meeting. We would be thrilled to work with you and begin your planning process. Call us at 833-WIN-RETIRE. That's 833-946-7384. Or visit our website at akersfinancial.com. Member FINRA SIPC.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, and here with me today is Mark DiOrio, the Chief Investment Officer at Brookstone Capital Management. He's been in this industry over 20 years, and he does a great job of working with Brookstone Capital Management to help us with third-party money management for our clients. Now, Mark and I did a webinar last fall, and we put it on our website, akersfinancialgroup.com. You go there, and up top you see Webinar tab. You scroll down, and you'll see some investment talks that we've had. You've also can go there and see more about investments, investment portfolios. You can see all the other topics under the webinar tabs. Most recently, we did one on Roth IRAs. Now, the other tab up there is a radio show where you can go back and listen to different talks, different shows in the past to get more information about something that might be of interest. This show will be on that website a little bit later this week. All right, so this show today has been this: are you properly diversified in today's market? And of course, I wanted to do the following question with you, Mark, and that's this. Your investment statements are the ingredients that create your retirement cake. And we're going to try to bake this idea this fourth quarter. Are you ready to do some baking, Mark?
Let's do it.
Oh man! Well, all right. So investment statements they come about the middle, about the 10th of the month, the middle of the month, and you get to look at them and sort of review where you are. And when people look at it, they open up one statement and they go, hey, wow, that's doing good. That's a good piece of cake. That's a good ingredient to my retirement. Then another one comes in and it's down, and all of a sudden they're thinking, oh, I'm going to sell the one that's down. And so they're upset that one lost money. The hardest part is that in a portfolio, when you bring all your ingredients together, that makes that retirement cake taste so good. But the hard part is not all stocks, not all your investments will go up together. Now, I view that as a good thing. What do you view this kind of concept when it comes to this retirement cake, building it with all these different ingredients, Mark?
Sure. Portfolio theory is really founded on the idea that you're combining these different pieces and you look at them in totality, not as individual ingredients, let's say, that you'd use on your own. You want to mix them together to build that cake, for example. You can't do it without the ingredients. They just don't do it by themselves. So you bring that together, and each of the pieces are playing a role in the portfolio. So one of them could be to reduce certain risks in the portfolio. Another one would be to capture some of the upside in a bull market or a rising equity market. So you really have to think of it in totality. And the reason you have those is because the market can shift very quickly. And so one statement, you think one investment is great and the other is terrible, and then the next statement, it could be the reverse. And that's very typical. And what the idea is that you combine these two and you've actually mitigated risk overall, and it's provided you that diversification.
Right. So this retirement cake, as we're talking, is designed differently for each and every person. And so the younger people would actually have certain ingredients of growth. Now, we still recommend value, and you look at the diversification across international. There's a lot to it in designing a portfolio for younger people. And then this cake changes as you get to retirement and as you're in retirement. The more income you need, the lower the risk you need to take in your portfolio. When you don't have a need for income, you actually can take more risk and allow that portfolio maybe to grow even further for other purposes. Now, when you think about asset allocation and design for people, what are your thoughts? What kind of things help you decide when designing a portfolio for someone?
Sure. And we take a secular view and then break it down into a cyclical view, which is shorter. So secular, think longer term. Cyclical, think shorter, 3 months to 1 year. But when we're thinking about portfolio construction today, it's really important to know we're building portfolios for tomorrow's challenges, not, for example, for 2008's challenges, which was a lot different. And as I mentioned earlier, and we were talking earlier, in 2007, 2008, it was a household sector, over-leveraged, but you had interest rates at 5%. Today, you have the government sector that has assumed all that debt, and so it's a government debt challenge going forward. At the same time, they're spending a lot of money, hopefully to get us through the pandemic and then beyond and get the economy back on track. But for investors, interest rates are near 0%. And so you have this very low interest rate environment. So we want to look at a portfolio and say, okay, how can we augment income or reduce risk in the equity portfolio? So we've used a few really innovative ideas on the bond side. We want to make sure we reduce what's called our interest rate risk. That's the risk of interest rates rising, which would have your bonds decline. So we've reduced that in a number of portfolios, and we've looked at some very actively managed bond strategies that we've included in the portfolio, as well as some other ideas that might augment income. And really, as we mentioned earlier, really thought about how dividend income plays a role in that. So dividends would be coming off of stocks. And a lot of those are high quality companies that we've heard of and we may have heard of for years, but they play more of a role in retirement to fulfill that income role where bonds really have a lack of income today. So we really want to have a little bit more thoughtful approach to portfolio construction and what each of those pieces or ingredients are doing.
Nice, you threw that ingredient comment in there. I like that. Yeah, so basically at Akers Financial Group, we start with people's unique financial fingerprint, where they are, where their portfolio is. And yes, we need to open up those statements and then put it all together to see how you're allocated. What's amazing is to find some people are too heavily at risk, and some clients have no risk at all. Very rarely does it come in properly balanced when we view it on the whole. Because many people purchase things throughout their life, they sort of buy things, buy investments, and they never put it all together. What a sound financial plan does, it begins with the client and all their information, and takes that information and builds where they are. Knowing where you are, you then can say, well, what do I need to change to make this better for the situation that I'm in now? Now, clients that are younger and just getting started, we love Roth IRAs, and we love to be in that growth and that thematic investments to really try to grow that money over time. Now, today we talked about concepts of core and satellite, value versus growth, thematic investments, bonds as a way to reduce some risk. We covered diversification. All of that is the overriding thought process of designing what's best for a client. When we bring in a group like Brookstone Capital Management to manage money, they provide many portfolios that help answer this. We do this on a fee basis. Now, Mark, have you ever counted how many portfolio design possibilities that your advisors have that use Brookstone Capital Management?
Well, one of the great things about the platform and what we tried to do was make it as flexible as possible. And what we try to have is, and try to provide, is strategy leadership, an enhanced opportunity set, meaning we've covered a lot of areas. We've already researched a lot of thematic ideas. So if someone comes to us and has a thought or has a client with a preference or their own preference and ideas, we've usually researched it and have some ideas already and some talking points. And then from there, collaboration. So there's any number of combinations that you can come up with. Now, that doesn't mean that the principles of diversification change. That means the application of those principles change with the conditions in the marketplace and the challenges we see from this point going forward.
Absolutely, and that's what's really helped us with working with our clients over these years. Now, Akers Financial Group, we are financial advisors, we're investment advisor representatives, stockbrokers. We do a lot of things for our clients, mainly implementing the plan that we put together. So when we talk about having a free meeting, that free meeting is where you sit down and talk about where you are. And that's just the beginning of how we start, getting to know each other, seeing if we're a good fit. Now, the reason we bring on a great portfolio people like Mark DiOrio is that his knowledge is why we choose Brookstone Capital Management. These kind of companies give us the backbone, the core pieces that we need for our clients to do well, no matter what happens in today's market. Because there are many uncertain items, and there's many things to think about to the future, and there's many, many choices. And that's what we try to do, is really evaluate where you are and what your needs are, and bring in companies to help provide what our client needs. Because we believe that the portfolio design and strategies is a full-time job. Now, you have a lot of people helping you with design and trading and working at Brookstone, and then you bring in all these other people to help manage money. So Brookstone's been a growing asset firm. You've gone from $1.5 billion to $7 billion over the last 6 years, right, Mark?
Correct. So it's been a very exciting ride, and we've have added in a lot of key areas and really improved our staff. So I think we're well positioned going forward.
Absolutely. Now, Mark, what are your closing thoughts that you want to give out to people when it comes to this question? Are you properly diversified in today's market?
To really make sure you've thought through the challenges of bonds and of stocks and where the income's going to come from and how you're going to defend the portfolio from certain challenges going forward, such as a rising interest rate regime, as an example.
Absolutely. Well, Mark, thank you very much for your time today. I really appreciate you coming and talking to us on the Winning in Retirement.
Oh, it's my pleasure, Brian. Thank you.
No problem. Now, in retirement, the biggest worry of your day should be where to drink your morning cup of coffee, where every day seems like a Saturday, free of stress. Your retirement income or investments taken care of by the team of advisors at Akers Financial Group with its core companies helping invest the portfolios. If this is the future you want, it's not too late. Go ahead and give us a call for a free meeting. Call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call and leave a voice message, Susan will call you back on Monday to schedule a phone meeting, virtual Zoom, or an in-person meeting with one of our team of advisors. Start planning for your retirement now. Give us a call at 833-946-7384 or visit AkersFinancialGroup.com. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.
Losing someone special can be one of the hardest times of your life. Baltimore has relied on the Evans Funeral Chapel and cremation services to help them during some of the most important family moments. Let the Evans Funeral staff make your difficult times as easy as it can be for you and your family. Evans Funeral Chapel and Cremation Services, serving Baltimore families since 1865, a tradition of comfort and caring. Visit evansfuneralchapel.com for more information. That's evansfuneralchapel.com.
Knowledge is power. How much better would life be if you had the power to provide a financial umbrella for your family? Protect your estate? Retire without any lifestyle compromise? Obtaining this kind of knowledge is as easy as making a call to Akers Financial Group with a focus on helping you make decisions that reach far beyond the typical life stages. Akers Financial provides comprehensive, innovative, and personalized wealth management services. Call us at 410-692-9870 or visit our website at akersfinancial.com.
Member FINRA SIPC.
Imagine you're retired. You wake up in the morning and you don't even know what day it is. Every day seems like a Saturday. You can sleep in, cook a nice full breakfast without thinking about morning traffic or work deadlines. The Saturday calmness you used to crave is now your everyday feeling. You're not worried about your retirement income or how your investments are doing. Your biggest decision that day is where you're going to drink that first cup of coffee. Is that the kind of retirement you want? If it is, then sit down and talk with the team at Akers Financial Group. They want to help you get there. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC.
Are you reacting or creating with your investments? When you have a sound financial plan, you don't have to be reacting every day. Let us help you create. Tune in to Winning in Retirement, Saturdays at 11 a.m. on 105.7 The Fan. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated, member FINRA SIPC, and investment advisory services offered through Kalos Management Incorporated, both located at 11525 Parkwood Circle, Alpharetta, Georgia, 30005 678 1100. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services.
The preceding was a paid program, and the views expressed do not necessarily reflect those of WJZ-FM, Odyssey, its sponsors, or affiliates.
WJZ-FM, Kingsville, Baltimore. From the Thompson Creek Window Company studios, the one window replacement company that does it all. This is 105.7 The Fan.
He broke his feet. Got it! Oh, track ball, guy!
Odyssey Sports Station.